To Feroze Azeez, who's the joint CEO at Anand Rathi Wealth, joining in with his expert take on the market. Feroze, good to have you on NDTV Profit as always. Now, my first question: what is really, coming in as a resistance when Nifty 50's rise above or holding on above 24,000 levels is concerned?
Good afternoon, Nisha. I think, of course, there has been some degree of consolidation at 24,000 levels. If you look at last three expiries, incidentally, we've been very close to 24,000, just 100 points up and down from that level. This is seldom does it happen that the market consolidates three monthly expiries at that level. I'm very, very glad that there is a lot of buoyancy in the market. When you look at a lot of news flow has happened, a lot of money flow has also happened. A lot of stock has changed hands, but the market has found its resistance. I had called out that the market will not fall more than 7, 8, 10%, even when the war broke out in February. And I think that's what has happened. 30th March was the least level for the last financial year. Incidentally, almost the least level, 22,313, and we are about 7, 8% higher. Now, what is the resistance? I think the resistance isn't there from a long-term perspective. From a short-term standpoint, of course, there is some resistance. Of course, this prop traders making it difficult. SEBI has made it difficult for prop traders, and that will actually bring in a lot of stability on expiry day. And that's what I think I'm very, very happy about. Because if you see yesterday's expiry, you see those scandals of 100-point Nifty movements. Those are all induced by algorithms, largely benefiting prop traders. So the expiry day volatility, where you always see on the last expiry day the market falls, not because of fundamental reasons, because of algorithmic trading, that will become far better, because otherwise you would never get a 100-point Nifty tick twice in the last half an hour.
Right. So, Feroze, I'm trying to break down the several factors which are really impacting the overall market momentum, and especially Nifty 50 as the benchmark number to really track as a yardstick. So, when we look at the war dates from 28th of Feb, it is over 1,000 points of recoup that is yet to be done purely on the basis of the war impact on Nifty 50 numbers. And when we look at the future, crude oil prices are still $10 above or at least $8, $9 above what it was pre-war. But pre-monsoon or during monsoon, lower than expected El Nino impact and the margin impact in the upcoming earnings. These are the factors at play. What's really impacting the market, and how do you see the momentum going forward?
Like you rightly said, the markets are about 1,100 points lower than where they were on the 26th, I think was the Friday. In fact, Friday market gave away 300-400 points. So in fact, I would count it as 25,500 down to 24,000 currently. It's about 6% down. You're absolutely right. War almost seems to have finished. Crude oil, I think you would have heard me say, data gives you a lot of informed guesses. Like last 13 instances in the last 50 years, crude oil, when it rose 50%, it fell back 28% within a year, except two instances, which are not because there was a supply shock. There was a demand recovery, basically COVID and GFC. So it was very easy to predict, of course, very difficult to believe that crude oil had already peaked out. So I think, why is the market not back at the same level? Will it come back to the same level? The answer is yes. Like I have been predicting that FIIs will come back sooner than later. The first 15 days, the first 15 days of June, of course, had an FII outflow. After a lot of time, we've got 2 weeks of positive inflow from FIIs on a net basis, which I think is a reasonably positive sign. So if you break down, like you said, Nifty is a great barometer of the market. The top 10 weights of Nifty is 54%. Top 10 weights of Sensex is 64%. That's why you would see, if you check the Sensex return and Nifty return of 6 months, you will see almost a 2.6% divergence. That's because FIIs were selling what they owned. They owned, so far also, they owned 39% of Nifty's free float. And they were selling what they owned. And when they sold what they owned, Nifty, the top 10 stocks underperformed, is why Sensex underperformed Nifty, which never happens. I think that convergence has started happening when the FII monies come back. I think Nifty will do well because the top 10 weights. have had a lot of dent because of this outflow, especially private sector banks, because that's 5 out of the 10 Nifty stocks in the top 10 category.
So, Feroze, multi-billion-dollar question: when are FIIs going to make a return, and what will give them the comfort?
I think if you look at FIIs return because they follow passive. It's very easy to predict an FII's return. If you look at MSCI Emerging Market Index, where almost $2 trillion is being it's a proxy to almost $2 trillion of wealth. So I would say when Korea and Taiwan and Chinese markets don't do well, we'll have more weightage towards India automatically. And that's when FIIs will come back. And that's why you see last 15 days, you're seeing positive moves, especially in Nifty stocks. You're finding FII purchases, which is also easy to track on a monthly basis using a Bloomberg terminal of a specific feature. So coming back, when do I think? I think by the September review, MSCI reviews every 3 months, February, May, August, and November. I think the August review will give us some more weightage. And there could be some reallocations, especially given how Korea has been behaving over the last fortnight.
Right. And Feroze, when we enter into the earnings season, now July has begun, and in a few days the earnings cycle will also begin. And this is the quarter where a large part of the impact of the war has been seen on the ground, and the full quarter has seen the impact. How are you differentiating between the sectors with knee-jerk reaction, even though the future potential for the next quarter is going to look much more better and recovered, but at least the numbers at the current moment, there could be margin pressure on several sectors. How are you differentiating, and in the short-term play, what's your view?
See, if you like, again, I would take you back to the Nifty argument, which I think is a very, very important argument, because that's what is a barometer of how market is doing for most of us. And that becomes the base on which anybody creates a portfolio to create excess return over it. So if you look at the top 10 stocks, you have IT stocks, 2 FMCG stocks, 4, 5 banks. They have not had an impact. In fact, they've had a benefit. And both these sectors, especially the banking sector and the IT sector, are at their bottoms. When earnings are bad and still the stock can go up, that's when you see a stock bottoming out. That's a huge indication the stock bottoming out. So this time, even if the results might not be stupendous, you will see stocks bottoming out and doing well on bad results. That's because there's a lot which has been factored in. Of course, you were speaking about a stock which gave a warning before its quarter result, and you see that stock down 10-15% today after having fallen 5-7%. I was just logged in a little early and I was hearing you. So point I'm trying to make is results, if you look at all the 4 indices which I track, Nifty, Nifty 100, 150 mid cap and small cap 250, which is what is the mutual fund barometer, I think earnings of more than 10% year on year for the same quarter is possible at an aggregate level.
All right. And also baking in the recovery that is to be seen in the next quarter. That could be the theme of this earnings cycle and the market momentum. Feroze Azeez, always a pleasure to chat with you. Thank you so much for joining.